What's up everyone, it's Caddy with Money Investing. In this video, we are going to be talking about retirement planning and saving. And I'm going to show you exactly how you can calculate exactly how much money you need in your retirement. In other words, as you're approaching your retirement, how much money you need to have a very seamless, very easy, and a very graceful retirement. Because I've been reading a lot of reports recently in February and March that there are many people out there that are actually unfortunately struggling when they approach their retirement. They have little to no savings for retirement. They're either coming back into the workforce and they're not able to meet their financial goals in terms of retirement planning. So that's what this video is going to be all about. In fact, I'm going to do you one better. I've got a free spreadsheet available for everyone. So if you're watching this video and if you want to download that free spreadsheet, the link's going to be down below. I'm going to go over that spreadsheet and exactly what you need to put in order to calculate that magic number for yourself. So hope you guys enjoyed this video and find it helpful. If you do, make sure that you drop a like and don't forget to subscribe to the channel. The link to our Discord and Patreon is going to be down below if you're interested in joining us. We'd love to have you on board. We've got a little bit over 3,700 members the first week of the month, and usually the first week of the month is the best time to join, so you get access to all the alerts, all the options alerts, trade ideas, swing trading videos, all the private videos, and all the member benefits as well. So let's just dive right into it. The first thing I'm going to break down is unfortunately some reports that I read. And these are from November 2022, February, and March of 2023. So 55% of Americans are behind on saving for retirement, and Market Watch pretty much says, and that's okay. I don't think that's okay at all. Like, I don't think that is something that we need to normalize and something that can be fine for people. Because look, retirement is a time when you are done with work, right? You no longer want to be working. You want to ideally, like from a more sort of traditional standpoint, you want to be somewhere on a beach, drinking on coconut water or whatever. But really, I mean, it all comes down to how well you plan, right? It all comes down to how well you're planning for your retirement. And again, there's another report from literally earlier March. Millions of Americans nearing retirement without any savings. About half of Americans ages between 55 and 66 have no retirement savings, right? That is dangerous. That is absolutely disappointing to read that statement, because like I said, I mean, if life expectancy is going to be closer to 85 to 90, that's a good 30 to 40 years of literally no savings and no income, right? So that is going to definitely play a big role. And that's exactly why I'm doing this video, because these headlines really bother me very much. Older Americans increasingly struggling to save for retirement. So hopefully in this video, again, this is the entire spreadsheet that we are going to go over. It's going to include your income, your savings, your other income, your portfolio investments, and then all the expenses. And we're going to kind of knock this one out really, really well and talk a little bit about, how to go about this entire spreadsheet. But one thing that I want to mention before we get started is that things will change, okay? So this is not like a perfect magic number that once you hit that, you're good. You can go ahead and retire. No, things will change as we grow older. Expenses come in, our income levels go up and down all over the place. We move, we start a family, we send kids to college. I mean, things happen, right? There's a lot of things that are going to happen. And as a result, things will change, right? So this number is not set in stone. It's just here to give you a framework, just an idea, and a set of guidelines on what you need to do in order to kind of get close to having a very successful retirement. And another thing that I want to mention is that there is no one number that's going to fit everybody, right? There's no one size that fits all, because everyone's in different circumstances, right? Everyone's got different financial obligations. Everyone's got different family obligations. So there's no one size fits all approach here. And it's more of a general understanding of and a framework on what you need to do in order to get closer to your goal. Okay, so you have to understand that, and you have to make those assumptions yourself, right? You know yourself better than anybody else. Okay, so you have to make those assumptions yourself. Okay, so let's just dive right into it. This is the entire spreadsheet, right? So what we have over here is some basic requirements, right? So your current age, that's what you're going to plug in, retirement age, and the life expectancy, right? So age, let's just start with, I'm going to go ahead and put in 30, right? Just as an example. Retirement age, the traditional retirement age is 60 to 65. Again, depending on your circumstances, you can put in whatever number you want. If you want to retire tomorrow, you can even go ahead and put, tomorrow, or you can put in a different year, right, as you're approaching retirement. So let's just go ahead and put 60. So what this does is that immediately calculates years left till retirement, right? So if I'm 30 years old, for example, I'm not 30 years old, but for example, I'm 30 years old and retirement age is 60, it automatically calculates my years left till retirement, which is 30 years. My life expectancy is going to be something that we have to also plug in. So for example, if I expect to live all the way up to 90 years old, right? So I'm going to plug in 90 over here, and then it's also going to calculate for you years after retirement. So once you're retired, how many years you have left, right? 30 years. And 30 years, this is going to be your retirement years, right? This is what we're trying to get to. And this is the number that we need to calculate, and how much money do we need in order to retire successfully. Now, next thing, which is going to be, debatable, is inflation, right? How much inflation are we going to experience over that next 60 years or so? Because again, if you take a look at your age right now and your life expectancy is 90, right? That's the next 60 years. How much inflation are we going to experience? So I'm going to go with 3%, just because inflation, on average has been around 1.5% to 2%, but then we're also dealing with higher inflation right now. And it is possible that, we kind of enter this new era of slightly above average inflation, right? So it's possible that we actually go with a little bit of higher prices, and it's better to be on the safe side than to be on the aggressive side. So if inflation ends up being 2%, great, you're going to be better off, right? But I don't want us to predict, let's say 1% inflation ends up being 3% and you're short your goal, right? So let's just go with 3%. So if it ends up at 2 or 1, that's even better, but at least we're going in with a little bit of a higher assumption there. So those are some of the things. By the way, everything that's in blue is what you have to make assumption for, like what you have to input, right, in the spreadsheet. That's what you need to put in, and everything in black, automatically the spreadsheet will calculate for you. So next we come down to the budget, right? So the budget is pretty much broken down into two pieces: a pre-retirement budget and a post-retirement budget. Now, the reason why pre and post is so important, because right now your expenses might be a lot higher than what you expect them to be after you retire, right? And that's going to change. Like I said, things will change as you grow, right? Things will change as years go by. And that's why we have to make at least some assumption that, okay, right now I'm spending on all these items this much. After I retire, a lot of these expenses will go away. And I'll show you some examples here. So let's just go with housing first, right? So if you've got a mortgage, if you've got a rent that you're paying, you can plug that number in. And this is simply for laying out these expenses, right? This budget right here has nothing to do with the spreadsheet. This is simply for you to analyze your current budget and how much you're spending on all these items. So for housing, let's just put in, $2,500, including, let's say, mortgage and interest payment and whatnot. $2,500. I know the housing in the US is expensive, so put in what you find appropriate here. Transportation for any vehicles that you may have, any car payments that you might have, we're going to plug in $500 here. Food is going to be groceries, right? So anything that you buy on a regular basis or, on a weekly basis for your grocery shopping list and whatnot. Let's just put in $250. This is the monthly budget, by the way. Make sure that you're putting in your monthly numbers. And then utilities, right? How much are you spending on your Wi-Fi, electricity, water, plumbing, all that stuff, right? Sewer, garbage, everything is included in utilities. We're gonna, let's say, put in $200. Again, I'm making assumptions here. This is not actual numbers. You have to put in your actual numbers. Health and wellness is gonna be any doctor visits, any gym memberships, all that stuff. Let's just put in $100 here. Entertainment, if you're going out, dining out, eating, drinking, whatnot, movie nights, whatever, you can put that number in. Netflix subscriptions, all that stuff is gonna go over there here. So I'm gonna put another $100 per month on this. Education, if you're paying for any student loans, if you are enrolled in any classes that you're paying tuition for, you can put that number in over here. Let's just go with a reasonable $500 because if you're 30 years old, right, and you're already out of school, maybe it's possible that you have some student loans that you're paying every month for. That's going to be $500. Insurance, any auto insurance, homeowners insurance, any other types of insurance, rental insurance, you can put that number in. Let's just go with a reasonable $250. And any family obligations, right? So if you are providing for your family, kids, your significant other, your partner, you can put that number in. right now, and of course that number it will eventually come off, because if your kids end up going off to college, then that number you're no longer providing for them, that number can potentially come down in the future. So let's just go ahead and put in a reasonable $1,000 for now, if you've got a family. Donations, if you're doing any charitable work, let's just put in $50 here. Travel, if you're planning your travel every single month or every single year, whatever the case may be, you can put in, let's say, $100. That's $1,200 a year in travel. I think that's a pretty reasonable traveling budget. Any miscellaneous expenses, anything that I haven't already mentioned, you can put that number in over here. So let's just go ahead and put in $100 per month. And any big capital expenditures that you think that might be coming up, if you want to fix the roof on your house, if you want to buy a new washing machine, a dryer, anything new, big capital expenditures, right? Big capex, you can kind of budget for that as well. So let's just go ahead and put in, let's just do $100 or maybe $500. That's a little bit on the higher end. So this is going to be your current monthly budget, right? Of course, I mean, it's going to change for everybody. Right now, the total monthly expenses end up being over $6,000, which is quite high, right? Total annual expenses at over $73,000. Of course, it's going to fluctuate for everyone. So you have to put in your numbers yourself. And then what you're going to do is you're going to make an assumption that, okay, this is my current budget. This is my pre-retirement budget. How is this budget going to change after I retire, right? Post-retirement, how is that going to change? Now, the way that's going to change is that, maybe you've got car payments that are no longer there because you've paid off your car. Maybe you've got a house that's already been paid off. Maybe, it's possible that, your kids have gone off to college, so you're no longer providing for them, right? Insurance costs may come down. Education expense, right? Your student loan might be paid off, so that there's no longer going to be that expense. So you have to, again, kind of see for yourself what's going to be your post-retirement budget, or at least what it's going to look like, right? What is it going to look like? Again, we're making some assumptions here so that we can kind of come up with a reasonably well-crafted plan. So maybe housing expense drops down from $2,500 down to, let's say, $500. Transportation comes down to, let's say, $100. Maybe you're taking a couple Ubers here and there. That's it. And then food, it comes down to, let's say, $200 per month, because different circumstances. Now, I want you to simply go with the current prices. I don't want you to account for inflation yet, because the spreadsheet is going to do that for you. It's going to calculate what that annual expense is going to look like, adjusted for inflation, post-retirement for you. So it's going to do that. You just have to go with the current level pricing that you believe is appropriate. Utilities, let's just keep that same $200. Health and wellness, keep that same. Let's just that increases, let's say, to $250, because as you're getting older, you're making more doctor visits. Entertainment, let's say that drops down to, let's say, $50 per month. You're no longer going out anymore as much as you did when you were younger. Education expense comes down to, let's say, $100. Insurance stays steady at $250. Family obligations, let's say they come down to $500 per month. Again, make those assumptions for yourself, what you see fit. Donations, let's say they increase to $100. And then travel, let's say that you want to travel more. So that number, let's just go ahead and put in $500 here. And then miscellaneous and capex, let's just say $100 here, and capex, let's just put down to $250. So your total monthly expense pretty much gets cut in half, right? It comes down from $6,100 down to $3,100 after your retirement, and majority of it is coming because of your well-being. So we can actually increase the grocery list here to 500, maybe a little bit. So 3,400 is what that monthly expense, let's say, that it comes down to from $6,100, because you no longer have those financial obligations. Your house is paid off, car is paid off, kids off to college, student loans paid off, all those things are paid off, so you no longer have those obligations. So all you're really spending on is your health and wellness, your food, your transportation, and your travel, because you want to travel after you retire. So your total annual expenses drop from $73,800 down to $40,800, and inflation adjusted, right? So at that point in retirement, when these expenses come in, it's going to be closer to $99,000. Yes, that is correct. After 30 years, that number is going to jump to over $99,000. This is annually, right? This is annual expense, and that's accounting for a 3% inflation. Now, see what happens if I do 2% inflation. So if I change this number to 2%, you'll notice that the actual annual expense dropped down to $73,900, right? So that's why inflation is so important for us to account for, because it is literally just, killing your purchasing power, right? That's why we recommend people that we invest, right? That you invest and take advantage of the higher rate of return in the market. So 3% inflation gives you $99,000 expense annually after retirement for this type of budget over here. And what this spreadsheet is going to do is that it's simply going to take into account $99,000 and it's going to plug it in over here. That's your total annual expense at age 61, right? And since our goal is to retire at age 90 in this example, we're going to come down to age 90. And this right here is going to be the annual expense at age 90, right? $233,000. And again, things will change. I have to keep mentioning it because, it's possible that your health and wellness, doctor checkups, different types of therapy, different types of, medicine, all that stuff increases and other stuff decreases, right? You're not traveling as much, but your health and wellness increases. So it's going to be offset by one way or another. But $233 is going to be that annual expense on that year, accounting for inflation. And this is going to be the cumulative total, $4.7 million, right? This is the total cumulative of all annual expenses from age 61 to age 90. So for that 30 years, that's going to be the cumulative total. But that's not the magic number, right? That's just the number if you were not making any money, right? If you were literally on zero income, that's the number that we would have wanted to hit, $4.7 million by age 60 in order to have a successful retirement, right? Because we need $4.7 million to keep up with our annual expenses for the next 30 years from age 61 to age 90. But that's not the magic number because we also got to account for investments, income, savings, and all those different things. So now we come to the second part, right? Now that we figured out the expenses and what our budget's going to look like, now we come down to what our investments and income and savings are going to look like. So what we're going to do here is that first we're going to account for the investments that we're making, right? So first things first, you got to account for the current portfolio. So if you're investing right now, you watching this video, if you're investing and making, market decisions and you've got a portfolio of assets, stocks, bonds, equities, whatever, you can put that number in. Let's just start with $50,000, right? Reasonable assumption. At age 30, got a portfolio of $50,000, monthly contributions, right? How much am I going to invest more into this portfolio? Let's just go with a modest $500. Annual contributions, this number should be calculated automatically. So that's going to be $6,000. I'm going to make that in black so you don't have to calculate that for yourself. So that annual contribution is going to be $6,000. And now you plug in that expected rate of return, right? What is going to be that rate of return that you're expected to generate over the next several years out? So in this case, I'm going to plug in 8%. In this case, I'm going to plug in 8%. So that's going to be that number. And it already accounts for your current age, your retirement age, and your years left. Because the thing is that you're not going to be making any more monthly contributions after you retire, right? That would be the idea. You can if you want to, if you've got more income coming in. But the idea would be that after you retire, you're going to start drawing from that portfolio, right? In order to fund your retirement. So a retirement age is 60. And years left is going to be 30 years. So in other words, for 30 years, you're going to be making those monthly contributions, right? And this is going to calculate your future portfolio value. So it's going to be sitting at just over $1.1 million. And this is pre-tax money. So you have to account for that as well. If you're investing in a Roth IRA, that's great. That's going to be tax-free. I don't want to make that assumption. So you have to decide that for yourself. If it's a pre-tax, post-tax portfolio value, $1.1, $1.2 million based on this plan, right? So $50,000 portfolio, investing $500 monthly at an 8% annual rate of return for 30 years gets you to $1.1 million. Next, if you've got any savings, you can plug that number in over here. So let's say that I've got $20,000 in savings, and I'm putting in another $500 in monthly savings here. So again, that annual contribution is going to be $6,000. And the rate of return is actually really, really low, right? For savings, if you're just pretty much storing money into a bank account, the rate of return is going to be 0.05, right? It's actually going to be really, really low. So your future savings value ends up at $201,000, right? So your portfolio value, since you're investing in the market, is over 1.1 million. Your savings portfolio or your savings value is going to be $201,000 because the rate of return is really low, but it's also risk-free, right? It's backed by the FDIC insurance and whatnot. Right now in 2023, we don't even know that. Anyway, so other income. Now we get down to some other income. So let's just say that you have other dividend stocks you're earning money from. You've got rental income. So if you own any rental properties, you can plug that number in here. If you've got any pensions coming in, if you've got any royalties coming in, any other income that you see fit that you can put in, you have to put in over here in these 4 cells. You can even, rewrite these things. You can put in something like else, other income, anything else, right? You can just plug in those numbers. So let's just go ahead and put, let's say, $1,000 in dividends every month that I'm receiving. Rental income, I'm going to put in, let's say, $2,500 that I get. I've got rental properties that pay me every month. And then pension, let's just go ahead and put $1,250. So total income after retirement, $4,750 per month is what I'm going to generate in this example, with respect to the pensions and the dividends and the rental income. So this cell pretty much shows you the total available on retirement, which is 1.3, almost $1.4 million. This is nothing but a combination of your future portfolio value and your future savings, right? So that's going to be 1.3 million. And total income after retirement, $4,750. That's the income that we calculated, right? Through various different streams of income. So now if you come over to our spreadsheet, this is what the actual numbers look like. Your portfolio value at age 61, $1.38 million, right? Growing at 8%. That's the ending portfolio value. Total expenses at $99,000. So once you draw those expenses out, your ending balance ends up at a little bit under $1.3 million, right? That's going to be that number. So age 62, you pretty much come down to 1.4 million and so on and so forth. I mean, this list continues to go down. And what your goal here is to come down to age 90, right? Because that's our retirement age. You come down to age 90 and you'll notice that you need to, in fact, save a little bit more because this number starts to turn negative. Our goal is to focus on this first one, portfolio value. Our goal, because that's really what we're going to be drawing from, right? Your investment portfolio, your savings, your retirement funds, that's what you're going to be drawing from to fund your retirement. So this is really where the focus needs to be, the portfolio value. If you come down, if this notice when this number turns negative, right? So right now, age 85 is when it starts to turn negative, right? Age 84, $107,000 left in your portfolio and your annual expenses, $195,000. So your ending balance ends up being negative, right? So this age 84 to age 85 is when this number turns negative, right? And your life expectancy is 90. It's all the way over here. So you are short right now. With this plan, you are short by about 6 years. So what you need to do is you need to pretty much come back and make some adjustments to this. Like I'll show you, if you even invest an additional $100 per month, go from $500 to $600 per month and hit enter, look what happens. Earlier, we were negative at age 83, 84. Now we're negative at age 89 to age 90. So we're like almost at our target. We're meeting with our target here. And age 90 is when the portfolio starts to go negative because our annual expenses are more than our portfolio value. If you increase this investment amount by, let's say, even $50, right? $50 extra. And then we hit enter. Now you have a very successful retirement because even at age 90, we're going to have about $447,000 left in age 90 terms, in accounting for everything else, for inflation, everything. That's how much money we're going to have left. And our annual expense requirement, $233,000. And as a result, this is a successful plan. So all you have to do is you pretty much have to go down the list and take a look at your portfolio value and when that turns negative. If it turns negative before your life expectancy here, then you need to tweak your investments and your savings goals in order to meet with your plan. If it turns negative after, then you're all set. You're on the right path towards a very successful retirement. And of course, you also have to account for this budget that we created because your total annual expense, adjusting for inflation, is pretty much calculated based on this budget right here, which is post-retirement budget. So when it comes to that future value, right, future magic number that you need to hit in order to be very successful in your retirement, it all comes down to this right here, total available on retirement. And the reason why this is so important is because you're basically going to be drawing from this fund, right? From this pool of funds in order to fund your retirement. So that number in this example is going to be a little bit over $1.58 million. And it's really not that much if you consider, right, all these crazy numbers that people throw around for retirement. Like I need 5 million, I need 10 million, I need $20 million to retire. Do the math. It's actually not going to be as much as you think it's going to be. And if you invest, of course, on a more consistent, on a more regular basis, these numbers are literally a stepping stone. I mean, you can even get to 2 million, 3 million, 4 million as you start to invest more consistently, more often, and kind of stick to a certain path, right? Consistency. And as Warren Buffett said, right, a fool with a plan can actually defeat a genius with no plan. And that's really what it comes down to, is like, if you've got a plan in place and you know what numbers you need to hit, what numbers you're working with, then you're literally going to feel a lot more comfortable as you approach your retirement. So that magic number is going to be ended up being $1.588 million. And that's also considering that you keep that money invested in the markets. Look, after retirement, people all the time, financial advisors tell you to kind of shift the portfolio a little bit more away from equities over to bonds because they're a lot less risky. So that's not being assumed here. It's assuming that that's going to be 8%. In fact, if you wanted to make that change, what you could do is you could simply take into account this number, and you can see how I have it multiplied by 1.08. We can maybe multiply it by 1.25. because that's really what the bonds on average pay. And you can make that assumption and kind of go with that, right? So you can just drop that down here. And then of course, you'll have to switch up your plan a little bit more in order to generate more future portfolio value so that you can have a successful retirement. So now you've got 877 when that number turns negative. So you need more money because you're not going to be invested in the markets after retirement. That's a big assumption that I'm making, actually. I got to point that out, that after age 60, after retirement, that money is going to be invested in the market, earning 8% per year. If that number, obviously if that investment goes away from equities over to bonds or even cash, then your magic number increases because you're no longer generating that rate of return, right? So you got to account for that. And if you have any questions, just let me know. I'm happy to help out in the comment section if you have any questions about the spreadsheet and kind of how to go around, play around with different scenarios, because this is one thing that I really wanted to point out, that if you're not planning to invest in the markets after retirement and switch that over to bonds or cash, then yes, you need to certainly have a much better plan. And let's just say that you don't invest in it at all, right? So let's just say that nothing happens and you just keep it over here. So let's just go down with it over here. Then of course your retirement funds run out at age 74. Then that means you need more, right? Then that means, let's just say $1,000, $1.9 million. It brings us down to 877. If we let's say that we put in another $1,500 here, so $1,500 total, that's $2.5 million. That comes down to age 82. Let's just say $2,000 extra per month, $3.2 million. And that's when we come down to age 85. And then finally, if we go with, let's just say $2,500, we come down to almost $4 million. And that's when our age 88, 89, we're like almost there. If we start saving a little bit more, let's just say 750, then we are at age 89, 90 a little bit. Let's just do 2650. It's a lot more trial and error, right? So $4.1 million. And that's when you've got a very successful retirement. So total available in retirement, this is your magic number, $4.4 million. If you don't plan to invest at all, if you want to just keep it in cash, this is the number that you may want to hit if in order to have a successful retirement. So hopefully that makes sense. Again, right now I'm going to put that back, making that assumption that that number is going to be invested in the markets, earning 8%. So we're going to do that over here, and we're going to add that number as well. Boom, right here. We're going to do this, and perfect. So let me know your thoughts down in the comment section below. As always, if you enjoyed this video, found it helpful, make sure that you drop a like, subscribe to the channel. As always, happy investing, and I'll see you all in the next video.